You are watching Elliott Wave Forex Trading. In this vid we will understand about market analysis. Will gold rates decrease in the coming days? The global gold market is navigating a complex macro environment characterized by a significant structural shift. After reaching an all-time high of $5,595.42 per troy ounce in January 2026, spot gold, XAU/USD, has entered a deep cyclical correction. Trading near the $4,130 to $4,160 liquidity zone, the precious metal has erased a large portion of its recent gains. Determining whether gold will continue to decrease in the coming days requires analyzing a mix of hawkish central bank policies, a strong US dollar, technical breakdown patterns, and geopolitical dynamics. In the short term, cyclical headwinds lean bearish, though strong structural support looms lower. Key macroeconomic drivers dragging gold down. The massive rally that defined late 2025 and early 2026 has hit a wall of fundamental shifts. 5 dominant macro forces are currently applying downward pressure on the metal. 1. The Federal Reserve's hawkish narrative shift. The biggest fundamental headwind is the rapid repricing of interest rate expectations. Earlier expectations of monetary easing have dissolved. Following sticky U.S. inflation prints, which hit 4.2%, markets have flipped from pricing in rate cuts to actively preparing for a potential rate hike. According to recent CME FedWatch data, interest rate futures are pricing in a roughly 58% cumulative probability of a rate hike at the September Federal Reserve meeting. Because gold is a non-yielding asset, a higher for longer or outright tightening stance by the Fed increases the opportunity cost of holding bullion, prompting institutional capital to migrate toward yielding assets like U.S. Treasuries. 2. A resurgent U.S. dollar and rising Treasury yields. Gold shares a deeply ingrained negative correlation with the U.S. dollar index, DXY, and real bond yields. Driven by high domestic interest rates and safe haven capital flight into liquid dollar cash reserves, the greenback has maintained dominant strength. When the U.S. dollar strengthens, it makes dollar-denominated spot gold more expensive for foreign buyers, naturally suppressing physical and speculative demand globally. 3. Energy shock contradictions. A critical geopolitical friction point emerged earlier this year with supply disruptions near the Strait of Hormuz. While geopolitical escalations traditionally spark safe haven demand for gold, this specific conflict acted as an indirect bearish catalyst. The resulting friction drove up global energy costs, which directly fueled the sticky inflation numbers mentioned above. The threat of inflation-induced central bank tightening has systematically overshadowed gold's traditional safe haven appeal. Technical architecture and key trading levels. From a technical perspective, the daily and weekly charts reveal that the path of least resistance for XAU/USD remains skewed to the downside in the immediate future, though it is approaching major historical support layers. The weekly head and shoulders risk. The long-term weekly chart has developed a clear bearish distribution pattern. Left shoulder, established around $4,500 in late 2025. Head, formed by the parabolic peak at $5,595.42 in January 2026. Right shoulder, topped out near the $4,850 liquidity pocket in April 2026. The critical neckline of this structural formation is a rising trendline traversing the $4,180 to $4,200 zone. Spot gold is currently testing this line. A decisive weekly candle close below this neckline would validate the pattern, opening the door for technical selling toward the deep value pocket between $3,300 and $3,400, which served as an accumulation zone in mid-2025. Daily parallel channel dynamics. On the daily timeframe, price action is confined within a well-defined declining parallel channel. The midline of this channel has acted as intermittent support near $4,141. Immediate resistance, the $4,300 to $4,400 zone, which acted as support throughout the spring, has flipped into formidable supply. The daily supertrend indicator remains firmly in the red, and the 20-week moving average is sloping downward, rejecting attempts at bullish mean reversion. Immediate support, if the current correction breaks lower, the next major historical support sits at $3,890.29. Institutional buyers are highly likely to defend the $3,950 to $4,000 psychological round number. The structural bull case: what limits deeper decreases? Despite intense near-term cyclical pressure, prominent institutional desks, including J.P. Morgan and Goldman Sachs, maintain that gold's structural foundation prevents a total collapse. Multiple factors are establishing a definitive floor under the market. Central bank accumulation: while Western ETFs are selling, global central banks remain aggressive buyers of physical gold. A World Gold Council survey indicated that 84% of central banks expect gold to occupy a larger share of global reserves over the next 5 years, driven by de-dollarization and diversification goals. Unreported institutional flows: alternative trade data from the London Over-the-Counter (OTC) market and Swiss refinery exports show strong sovereign and institutional buyers, particularly in Asia and China, absorbing physical gold on major price drops. Physical demand versus policy constraints: in major retail hubs like India, local import duty hikes, raised to 15%, have temporarily cooled short-term retail jewelry demand, but historical trends demonstrate that price drops of 15% to 20% consistently re-engage value-driven consumers. Summary forecast: will it decrease in the coming days? Short-term, coming days and weeks. Bearish range-bound: $3,950 to $4,180. Hawkish FOMC minutes: high yields, technical neckline breakdown pressure. Medium term, Q3, Q4 2026. Stabilization neutral. $4,000 to $4,400. Central bank physical absorption mitigating ETF liquidations. Long term, 2027 and beyond. Bullish. $4,600 to $4,900. Cyclical return to monetary easing and fiscal deficit expansions. In the coming days, gold rates are highly vulnerable to further minor decreases or sideways consolidation with a bearish tilt. Until the macroeconomic environment experiences a shift, such as a dovish pivot from the Federal Reserve or a significant de-escalation in global energy supply bottlenecks, the cyclical technical trend points downward. Traders and investors should closely monitor the $4,200 resistance and the $4,100 support levels. Failure to reclaim $4,200 will likely trigger another leg down toward the $3,950 to $4,000 psychological floor, presenting a textbook cyclical correction within a long-term structural bull market.